More on China's stock market. We're joined by Joey Lake. He is the global economist for the Economist Intelligence Unit. Joey, thank you for joining us.
Thank you for having me.
Interesting times, Joey, interesting times. Chinese stock markets appear to be pulling back from the brink a little bit. As we just said, Shanghai Composite closing up 2.4%. On Monday, we saw a rally. Thursday, Friday, the index gaining up 5% last week. Do you think that we're seeing signs of stabilization? Is the wild ride over?
I think it's far too early to tell, and I think that some of the measures that have been put in place by the Communist Party over the past couple of weeks really bode quite negatively for the market in the longer term. And I think it's important here to take the longer term perspective on this, because what's happened over the past month in China has potentially going to have a bigger impact not just on the Chinese economy, but on the global economy than a Greek exit from the euro or when Janet Yellen raises interest rates here in the US. They've really changed the direction of what we thought they were heading in.
Why do you say that these have been negative? Some people do concur, saying that they've sent more of a panic signal. Is that your opinion?
I would agree. Back in 2013, the Communist Party said that it was going to let the market play a decisive role in the economy. And I think a lot of long-term projections for the health of the economy depended on that. And what's happened over the past month shows us what the party will do when it hits some instability as it's pushing through market-based reforms. And so its tendency, we now think, is going to be to stop and to see if it can, again, pull a lever and try and engineer a lift to the economy.
So you're saying that there was just too much government intervention?
I'm saying that the government intervention over the past month suggests that in the future, when it's pushing through other market-based reforms, if it's liberalization of the exchange rate, if it's opening of the capital account, if it sees instability, it's more likely now, we think, to pause and try and again engineer a smoother landing for the economy.
But on the other hand, this is a market which is the world's second biggest market. About 80% of the transactions are by retail investors, mom and pop investors who are highly leveraged, who've lost a lot of money. Was the government supposed to not do anything to stop it?
I think that's a good question. And I think that the government response really, I think, should be judged more in a political light than an economic light, because the danger to the real economy of the stock market crash is going to be quite limited. The stock market in China accounts for around 30% of GDP. Here in the US and other developed markets, it's much higher than 100%. So the fallout for the real economy is going to be quite limited. I think that actually the government is stepping in because it wants to point the finger of blame elsewhere. It took a lot of credit for the success of the stock market over the past few years and the boom. And so now that the market is falling, it's pointing the finger elsewhere.
Let's talk about what some of the global banks have to say, trying to wrap their minds around what's happened here. Deutsche Bank calling the drop in the Shanghai and then Shenzhen a bubble burst. BOA, Merrill Lynch saying this could be as bad as the US subprime crisis. On the other hand, we've got Goldman Sachs saying, hey, this is just a correction. It's not a big deal. That it's fast and furious, yes, but this correction has largely run its course. Now, Joey, keeping in mind it's been a 30% drop, but yes, 150% is the return that the Shanghai Composite has had year over year. Yeah. So is 30% seems like a correction to me.
I would fully agree with that, and I think it's very important to put it in that longer term perspective. It's been an incredible bull run over the past couple of years, and it very much looks like a correction at the moment.
All right, let's talk about these measures, because you're saying there were too many, too much, sends a signal. People are agreeing in the sense that what happens when the government pulls back?
Right. Right, I think that's a good question. I think it depends. I think that the history of government intervention in stock markets tells us that there's going to be another period of volatility when the government does pull back. The Chinese government has got more firepower in its economic arsenal than pretty much any other government in history, so it can do a lot to try and support the market. But typically, market interventions by governments do not tend to end successfully.
What about the companies that have elected to hold their trading? We saw that 350 companies have resumed trading on Monday. There's still about 1,000 that have voluntarily suspended their trading to stop their stocks from plummeting. What happens when they resume trading?
Exactly. I think you're in for another period of volatility when the government does relax some of its controls and allows trading to be more free again. I think you are going to see a lot of investors who have been panicked by the fall over the past month and then panicked by the government response to that, and they're going to see that as an opportunity to get out of the market.
So the volatility is going to continue for the long run, is your view?
I would say that once these government controls are relaxed, I think you can expect to see more market volatility, which is what you would expect to see in a market.
Okay, so we haven't hit the bottom. Let's talk a little bit about the Hang Seng, because obviously that has been affected by what's happening in the mainland stock markets. Do you think that this makes the Hang Seng now a little bit more attractive because it seems a little bit more stable? I mean, it is still up about over 6% for the year.
Yeah, exactly. I would say that you've got short-term pain there and long-term gain, because in the short term it will be affected by what's happening on the mainland and it will be damaged by that. But in the long term, it looks like a much safer investment destination, just much more stable in terms of the policy environment. So it will look like a very attractive financial hub to serve the mainland in the longer term.
All right, we're going to have to leave it there. Thank you so much, Joey Lake, Global Economist for the Economist Intelligence Unit.